Nothing draws people's attention more than making passive money. A regular source of money with no effort is a dream come true. We are all financially reliant in some manner, but continuously sacrificing your time for money isn't a formula for a happy life, and passive income addresses that problem. Whenever we think about passive income, the first thing that immediately comes to mind is real estate, since you have definitely paid rent at some time in your life. You contributed to someone's passive income. Wouldn't it be amazing if you were paid every month by someone else? It's simple to see how real estate may be used to generate passive income. Stocks, on the other hand, may be as passive as real estate. There are several methods to profit from the stock market. One of which is to invest in dividend stocks, which split their gains with their shareholders at the end of each quarter. These are firms that are already proved themselves in their particular industries and have evolved efficient business strategies that allow them to not only produce money to reinvest in themselves, but also to transfer a portion of it to their shareholders. However, before investing in dividend stocks, there are a few factors to consider. First and foremost, how long has the firm been paying dividends? Companies that are struggling financially may begin paying dividends in order to attract investors and boost their stock values. As a result, the longer the corporation has paid dividends, the better. Another element to consider is how frequently the firm has increased its dividend payout. Every year we have inflation of at least 2%, and it may occasionally go as high as 8%, as has just occurred. Therefore, it is critical that the company boost its dividend payments yearly. There is a company known as the King of Dividends, and they have been increasing their dividends for the last 50 years. However, not all firms have been there for more than 50 years, which is why it is worthwhile to look at stocks that aren't on the King of Dividends list. The best dividend stocks are those that sell necessities, or things that individuals repeatedly purchase. Take Coca-Cola as an example. Soft drinks have evolved into a key part of our beverage intake. It's difficult to stop consuming cola once you've become addicted. It just becomes a regular habit. Antibiotics is another example. Since their invention in 1928, antibiotics have become an essential part of our lives, and it's difficult to imagine people stopping buying them in the near future. So companies whose expertise is antibiotics have developed themselves in this industry and can consider a steady stream of income for the coming years. So if you want to build a meaningful source of passive income from dividend stocks, you must first understand the company behind these stocks. So let's have a look at several dividend stocks that might help you generate a monthly income of $2,000, $3,000, or even $5,000. But first, a disclaimer. This is not financial advice, and everything discussed in this video is for educational and entertaining reasons only. Let's get started. Number 1, Johnson & Johnson. Let's know its products first, then at its dividend yield. First and foremost, this company is older than many nations, as it was established in 1886. It's a true American icon. Consider their most popular product, Tylenol, a pain reliever. I personally cannot live without pain relievers. I personally cannot wait for my headache to go away on its own, and I'm sure I'm not alone. You already know that this product is a consistent source of money for the company. Take, for example, bandages or Johnson's baby powder, which is one of the popular baby powders on the market. It is very essential for all parents. They offer a wide range of healthcare items, medical technologies, and other services. When this video is made, the stock had a dividend yield of 2.70%. That's really great for the stock market, given that many corporations like as Facebook don't pay anything at all while being near monopolies in their fields. The best thing is that it's been increasing dividend payouts for over 5 decades. If 2.7% isn't amazing, consider its stock price, which has climbed by 42% in the last 5 years. Of course, that has no bearing on the stock market, but that is the nature of dependable dividend stocks. Their stock price does not rise much, but they provide consistent dividends, making them an ideal choice for passive income. Number 2, Proctor and Gamble. This company is well known. It is a direct rival to J&J since it likewise focuses in a large range of personal health or consumer health, as well as personal care products and hygiene products. It has been on the market for what seems like an eternity, selling essential products, which makes its business model ideal for consistent cash flow. Its stock price has nearly doubled in the previous 5 years, which is not outstanding, but the dividend yield of 2.45% is what makes it appealing. Companies that provide such dividends never see such a huge increase in their stock price because investors anticipate the company to expand tremendously or develop a new technology in the future, such as Tesla. Tesla's stock price does not reflect the company's current value, but rather what investors expect it will be worth in the future. However, such a company cannot afford to pay out large dividends because the purpose is to create a lot of money in the future, not today. Let me know in the comments if you have any other questions about investing. Let's return to the video. Number 3, Edison International. It is a firm that offers energy. Its stock price has been pretty constant, hovering around 60 to 75% in the previous 5 years. Nothing groundbreaking, nothing complex here, simply a regular company that delivers basic essentials. The only reason it's on the list is that it's a utility company that serves the most densely populated states in the United States and has a dividend yield of about 4.04%. Number 4, energy companies. Energy businesses are among the best in terms of dividends, but among the worst in terms of stock prices, particularly when it comes to conventional energy sources such as gas and oil. The company's concept is straightforward. Collect the oil, refine it, and export it. Of course, some money must be invested into R&D to maintain developing the extraction technology, but it is the most expensive R&D expense until the corporation invests extensively in renewable energy. The last century has been a golden age for gas and oil corporations. Of course, that golden period is approaching its end, but we still have a few decades at most, particularly with all of these crises across the world. Meanwhile, oil prices are growing faster than ever, trading at more than $100 per barrel. Exxon Mobil is an excellent example. With a market valuation of $391 billion and a dividend yield of 3.75%, it ranks among the industry leaders. On the other hand, Shell gives around 3.63%. Phillips 66 has 4.13%, while BP has 4.14%. However, be cautious with gas and oil companies since their stock prices are very volatile as oil prices rise and fall. Number 5, REITs. REITs are the entry point into the real estate industry since they allow you to invest with little cash. Whenever you invest in REITs, you are actually investing in the real estate market as that is what REITs do. They collect investors' money and invest it in real estate, which is why they frequently provide the highest dividend yield in the market. At the time of this video, Annaly Capital Management had a dividend yield of 13.44%. The dividend yield on new residential investment is 10.7%. They suffered greatly in the previous 2 years as people battled to pay rent, but are slowly rebounding. However, you must remember that rates will continue to rise in the coming years, making mortgages more costly and potentially lowering property values. To get a reasonable income from dividends, such as $3,000 per month, you must invest between $400 and $650,000, assuming a 3.5% average return if you diversify. That's not ideal, but your assets will remain liquid, which means you'll be able to exit the game if you want the money right away. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.